Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Phil McKinitosh. He's the Chief Economist over at Nasdaq. And we're going to discuss a busy week of data. And of course, tomorrow on Friday, we have July, the employment report. Phil, the traders will be focused on that, 8:30 a.m. Eastern. What are some of your expectations going into the report?
Well, hi, Jill. Thanks for having me. It's going to be an interesting report, and the non-farm payroll number has been running at about 200,000 now for about 6 or 7 years. So that number itself hasn't really changed that much, and the expectations are pretty much around that, from 190,000 to 220,000. But what's really going to be interesting is what happens to unemployment. So we've had a bit of a Goldilocks period since 2011. That 200,000 number is enough to keep employment or unemployment coming down, but not wage growth going up. And so last month was the first time for a long time we actually saw unemployment tick back up. It went from 3.8 to 4%. When you looked at the data, a lot of that was because of a surge in the number of people in the workforce. So what the expectations are for unemployment is for it to actually come back down to 3.9%, which should be good for the economy, and it should actually be still not too hot to do too much to wage growth as well.
Right, but what about wage growth? Wouldn't that be good if it goes higher because then people have more spending power?
Yeah, it's a catch-22 in a way. Right. I mean, it's good for the people to see wage growth, but it's going to be bad for the economy if it starts to get too expensive to employ people. So where wage growth is running right now is about 2.7% annualized, and that's ahead of inflation, so that's good. But what we run the risk of is if wage growth starts to increase too much, inflation might come along with it. So net at the end of each year, if we've got inflation as well, you want your wages to be getting ahead of inflation, not falling behind inflation.
All right, so it's almost like if you get a good report, it could be a little bit tricky for the markets because it might indicate inflation and a change in rate policy and so forth.
Yeah, I think that's one of the big risks at the moment, and you've seen the Fed has said that they're going to keep increasing interest rates, and I think that's because they're seeing so many good numbers consistently coming through. With unemployment around 4% or maybe 3.9, there's not a lot of space left in the economy or capacity left in the economy to absorb extra production and extra sorts of demand. So they're trying to make sure that we don't overheat, because if we overheat, then we might get inflation, and that might actually lead to a bigger problem for down the track.
All right, we had another busy week of earnings. How do you think Q2 has performed so far?
Yeah, I mean, Q1 and Q2 have been really strong. Some of that is due to the tax law that passed in December, so reducing the tax rates on companies. But sales is strong, and a lot of the commentary coming out of the companies so far is strong. So earnings has been really good. And I think it supports the valuations that we've got in the market. If you remember back in January, people were talking a lot about the rally post the tax changes maybe overheating the stock market. But if you look at the stock market since then, we've kind of drifted sideways for the large part, and earnings have caught up. So I think we've got a much better valuation argument for the stock market right now too.
All right, and to wrap up, how do you feel about the trade tariffs? I mean, eventually these are going to trickle down cost to the consumer, and we're seeing that. You know, even a couple of the car companies have said that they are going to increase prices because of what's happening with steel. How could that potentially impact the market? The cost has to go somewhere.
Yeah, I think the cost is one aspect, and the uncertainty is the other aspect that everybody's looking for. But in the data, there's no evidence just yet. I mean, some of the tariffs only just started to go into effect. There's a lot of other that are threatened and haven't actually started. So if you're looking at the data, which tends to be a little bit historic, there's not a lot of evidence yet that the tariffs are having an impact. One of the interesting things coming out of the earnings season, though, is the number of times tariffs are getting mentioned in the earnings calls. And so that's increased really significantly, especially for consumer companies, whether that's staples or discretionary.
Right.
And it's also increased for the materials and industrial companies. So obviously those sectors are more exposed to the tariffs, or consider themselves to be more exposed to the tariffs. They're talking about both aspects. They're talking about increased uncertainty just in terms of what they're going to do in terms of investing in the future, and also having to pass prices through to consumers, which will lead to inflation.
Well, it's really interesting because the consumer companies tend to round out earnings season. So over the next couple of weeks, we'll be getting that commentary on the conference calls and so forth, you know, in addition to what's out there in the marketplace now.
Yeah, so we'll have a better picture of, I guess, what the companies think is going to happen to inflation as well, and whether they can pass the costs through.
All right. Well, thanks very much for joining me at MarketSite today, and thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.